Banks panic buy as silver breaks 77 plus, not because they want to, but because they have no choice left. The vaults are empty, the paper price is broken, and a $5 billion institutional wave is now forcing the market into a vertical repricing event. But what triggered this? A war, a shortage, or a trap that they set for others and accidentally walked into themselves? Because what's unfolding right now is not a rally, it's a reckoning. And by the time you realize what's really happening, the real price of silver may already be unreachable. Stay with us. Because what you're about to hear could change how you see the next 10 years of your financial life. Welcome to John AG, where we connect the dots others won't even draw. If you're over 50, you know how quickly things can change. So before we go further, hit that subscribe button like your retirement depends on it. And tell us, where are you watching from? Let us know in the comments below. On the morning of January 5th, something changed. The global silver market, which for years had been tightly controlled by a system of paper contracts, market makers, and financial engineering, suddenly broke formation. At 8:12 a.m. Eastern Time, silver crossed $77 per ounce, and it didn't stop. For traders on the floor, the chart looked aggressive, too aggressive. Prices weren't rising in steps. They were leaping, gapping, ignoring resistance. It was the kind of move that didn't look like a rally. It looked like an escape. And for many large institutions, that's exactly what it was. They were not buying silver because they wanted to. They were buying silver because they were cornered. What unfolded in those first few hours wasn't a reaction to news. It was a systemic response, a forced response to months of miscalculated positioning, broken suppression strategies, and an external catalyst that no one inside the financial system had properly prepared for. It began with a war headline, but it ended with a market-wide realization. This time, the old tools won't work. For most of December, silver had been locked between $70 and $75 per ounce. Every time it tried to move higher, it was pulled back down by layers of sell walls, artificial barriers created by major institutions to keep prices stable or in their favor. Banks shorted futures contracts. Algorithms painted the tape. Technical traders were discouraged from buying. It was a system of control, and it had worked. Until it didn't. The shift began over a weekend when global markets were closed. News broke that the United States had launched a sudden military operation in Venezuela. While politicians framed the move as a response to political instability, the financial world saw something else entirely: resource acquisition. Venezuela holds the largest proven oil reserves on Earth. And the timing of the operation, quietly executed on New Year AS weekend, sent a message to every other nation that watched from afar. Your resources are now at risk. This message reached markets in a different language: risk repricing. The first cracks showed when silver reopened Sunday night on the Globex electronic system. The price didn't tick up like normal. It gapped up, jumping from $71 to $73 within the first minute of trading. That jump wasn't retail investors. It was institutional capital, smart money, entities that had read the headlines, ran the risk models, and understood what was coming. They placed market on open buy orders for thousands of contracts. Their logic was simple. In times of war, physical assets with no counterparty risk become essential. Silver, already in short supply, was now a dual-use asset: monetary and industrial, safe haven and strategic input. And the largest player in the world, the U.S. Department of Defense, had just added silver to its active material list. By the time U.S. markets opened Monday morning, the damage was already done. Banks that had entered the new year with short exposure were in immediate danger. Some had sold futures to suppress price for regulatory optics. Others had taken aggressive bets on a post-holiday cooldown. But silver didn't cool down. It caught fire. The price rose past $74, then $75, then $76. Each level was supposed to hold, but none did. The reason? These resistance levels were built on confidence, not collateral. They assumed the presence of liquidity, but there were no sellers, only forced buyers. Those who had gone short were now trying to cover, and the faster the price rose, the worse their losses became. This triggered stop-loss orders, preset instructions to buy when the price hits a certain point. Thousands of contracts were activated all at once. The market had become a reflex loop. Rising prices triggered more buying. More buying triggered more panic. Panic forced the banks to retreat. For many watching, this seemed like another short squeeze, a technical move, but that was only the surface. Underneath, a much deeper shift had occurred. The price was no longer being driven by sentiment. It was being driven by necessity. Forced buyers, institutional repositioning, sovereign risk. The $77 breakout wasn't just about silver. It was about a system cracking under pressure. Western banks had lost their ability to suppress the price. The tools they once used, leasing metal, dumping supply, manipulating paper contracts, were either exhausted or irrelevant. Vaults were low. ETFs had already absorbed most available float. Asian buyers were offering higher premiums for physical metal. And now, the military had entered the demand side. Suddenly, banks found themselves on the wrong side of the trade, not against retail, but against their own government. For the business community, this moment is more than a headline. It's a signal that the age of artificial pricing may be ending, that price discovery, real price discovery, is returning to hard assets, and that capital flows, especially institutional ones, are shifting faster than most realize. What began as a simple rally has revealed something much larger, that the geopolitical landscape is forcing resource repricing, that financial engineering can no longer suppress physical reality, and that those who assume control would continue forever are now the ones forced to cover. This is why the $77 breakout matters, not because it's a number, but because of what it exposes underneath. While Wall Street was reacting to military headlines and short-covering chaos, a second force was quietly shaping the trajectory of silver, one far more enduring than geopolitics and far less understood in the West. The price of silver in New York had just broken above $77, but in Shanghai, it was already over $82. This divergence is not temporary, it is structural. And for any business leader, investor, or institution seeking to understand where capital is flowing and why the system is showing signs of strain, this arbitrage gap is the signal hiding in plain sight. It is not a glitch, it is a mirror, one that reflects the real state of global demand, physical scarcity, and regional priorities. To understand the gap, one must begin with fundamentals. The silver market is not one single price. It is a collection of regional prices shaped by physical availability, local demand, and currency liquidity. In theory, when prices differ, arbitrageurs, traders who seek to profit from price differences, step in. They buy silver where it's cheap, ship it where it's expensive, and pocket the difference. This process usually keeps prices in line, but today that process is failing. In Shanghai, silver is trading over $82. In COMEX, it's at $77. The gap is widening, not closing. And that tells us something critical. Arbitrage is no longer working. Not because of a lack of traders, but because of a lack of metal. There simply isn't enough silver in Western vaults to meet the demand of Eastern buyers, and the ones who do have it aren't selling. China's demand is not speculative. It is industrial. It is strategic. It is institutional. In January, new production quotas for solar panel manufacturers were issued across multiple provinces. These quotas require physical silver, not futures, not options, not ETF shares. Real bars, real tonnage. Chinese factory managers are facing inelastic demand curves. They cannot delay procurement. They cannot afford shutdowns. If a factory requires 2,000 ounces of silver paste to meet its Q1 production target, it must acquire it at any price, or risk falling short on national targets and incurring penalties. This is not a Western trading desk deciding whether to take a long position. This is a government-aligned industrial engine executing on orders, backed by capital, planning, and urgency. That urgency is visible on the screen, and it explains why the Shanghai bid continues to rise, even as Western traders interpret silver's rally as overheated. In the East, it's not a rally, it's procurement. Meanwhile, the West is bleeding inventory. Data from the London Bullion Market Association, LBMA, and COMEX vault reports confirm that eligible silver, that is, silver available for delivery, has been in consistent decline. Some vaults have reported double-digit percentage outflows over the past 90 days. The metal is flowing eastward, pulled not by price speculation, but by premium-based purchasing orders coming from China and other industrial centers. This is why arbitrage fails. The metal being bought in New York or London isn't ET making it to China via speculative trade routes. It's being acquired directly by industrial players at origin, bypassing the arbitrage mechanism entirely. And more importantly, it's not returning. This flow has consequences. Each ounce of silver that leaves Western vaults to meet Eastern demand removes future optionality for Western institutions. Banks, refiners, ETF custodians, all are watching their available float decline. And once that float is gone, they are left with exposure but no collateral. This is where the system enters dangerous territory. If COMEX futures contracts promise silver at $77, but physical silver trades at 82 pluses elsewhere, and there is no available metal in New York to meet delivery, then the paper price becomes a fiction, a placeholder, a theoretical construct no longer grounded in accessible supply. At that moment, the system must choose, raise the bid to retain physical stock, or default, via cash settlement or delivery delays. We are approaching that moment now. The business implications are serious. Manufacturers in the West, especially those in electronics, medical devices, or renewable infrastructure, are already reporting longer lead times. Dealers and distributors have quietly begun raising premiums. Even retail buyers are noticing extended delivery windows for standard bullion bars. What does that mean in real terms? It means that silver is no longer a commodity priced by paper contracts. It is becoming a strategic resource priced by whoever needs it most and is willing to pay more for immediate access. And today, that's not Wall Street. It's not London. It's not traders. It's Asia. The 527 arbitrage gap between Shanghai and COMEX is not just a pricing anomaly. It is a heat map showing where true demand resides and where supply is no longer sufficient. It is also a warning that the Western financial system, long accustomed to using futures to simulate supply, is running out of time. Because if the Shanghai price keeps pulling higher and the vault drain continues at this pace, the ability of Western exchanges to defend their quoted price will vanish. In that world, the COMEX price becomes irrelevant, and the real price, the Shanghai price, becomes the new global benchmark. Not because anyone agreed to it, but because the metal moved. As the price of silver surged past $77, it wasn't the retail buyers leading the charge. It wasn't the industrial buyers either. It was the banks, the very institutions that had been suppressing silver for months, now forced to buy back into a rising market. They were not repositioning. They were retreating. And they were doing it under pressure. This was not strategy. This was survival. In the final week of December 2025, major bullion banks had executed a familiar playbook. With year-end balance sheets due and regulatory capital scores under review, they sold silver heavily into low-volume holiday trading. Their goal? Suppress the price, reduce mark-to-market liabilities, and clear their books at minimal cost. The price fell to $70 rather than $50. It was, by all appearances, a success. But it came with risk. That risk materialized just days later when geopolitical tensions erupted in Venezuela and the Shanghai premium widened. By the time markets reopened in January, silver had not only recovered, it had jumped. Banks that sold at $70.50 were staring at a $5, $7 per ounce loss. On leveraged positions worth hundreds of millions of dollars, that gap was catastrophic. They had sold the bottom. Now they had to buy the top. And worse, they weren't alone. To understand the unfolding dynamic, one must first understand the mechanics of a short squeeze. When an institution shorts silver, that is, sells a futures contract without holding the physical, it commits to buying it back later to close the position. If the price falls, they profit. But if the price rises, every dollar higher means greater losses. And if the price crosses key technical thresholds, their risk models force them to cover, to buy back in, regardless of cost. This is what happened above $75. That level wasn't just a round number, it was a technical ceiling that had capped silver for months. Banks had placed layered sell orders there, a wall designed to hold back momentum. But when silver broke through that wall, a series of automated stop-loss orders were triggered. A stop-loss on a short is a market buy order. Thousands of them, simultaneously. This triggered a reflex loop. Buying pushed the price higher. Higher prices triggered more buying momentum traders joined in. Algorithms detected the breakout and accelerated purchases. And in the middle of it all were the banks, trying to exit positions they had once used to dominate the market, but they were now chasing their own losses. The deeper problem wasn't just the price action, it was the structure of the trap. Imagine three banks, Bank A, Bank B, and Bank C, all holding short silver positions. All are losing money as the price rises. They each want to buy back in before it gets worse. But here's the dilemma. If Bank A buys first, it pushes the price up, making things worse for Bank B and Bank C. If Bank C hesitates, it pays the highest price. So who buys first? This is the essence of a prisoner's dilemma. The logical decision is to exit early, even if it hurts your peers, because delay only makes the problem worse. What follows is cannibalization, one bank sacrificing the others to survive. And once that coordination breaks, there is no suppression mechanism left. The wall collapses. Each institution fights for its own survival. This is what the silver market witnessed on January 5th. Making matters worse, the banks were also exposed on the option side of the market. Many had sold call options, contracts giving buyers the right to purchase silver above a certain price. Once silver crossed $75, those contracts moved in the money. That meant the banks now faced delivery obligations, or had to hedge their exposure by buying futures. This phenomenon is known as a gamma squeeze. The higher the price rises, the more futures the banks must buy to remain hedged. Their own hedging activity drives the price higher, forcing them to buy even more. It is a feedback loop, driven not by emotion, but by math, and it amplifies the rally exponentially. Combine a short squeeze with a gamma squeeze, and the result is vertical price movement. That's not speculation, that's structural combustion. In past years, when banks were caught in such traps, they had an escape hatch, physical supply. They could lease silver from central banks, sell physical bars from vaults, or pressure refiners to release more stock. These actions would cool the rally, restore confidence, and allow them to cover positions at lower cost. But in 2026, that hatch is closed. COMEX vaults are at their lowest since 2016. London inventories are being drained by Eastern arbitrage. Refiners are already booked by industrial buyers. The US Mint has suspended sales due to lack of supply. The banks have no metal. They cannot dump what they don't have. Their only option is to buy back paper contracts at any price the market demands. This transforms them from suppressors to support. Their panic becomes the bid. For those in the business and investment community, this shift matters. It signals that silver is no longer just a commodity to be managed by financial players. It is becoming a battleground asset, one where the usual rules no longer apply. The institutions that once dictated its movement are now reacting, not leading. The power is shifting, and the market knows it. We will analyze the final catalyst, the entrance of institutional allocators, pension funds, endowments, sovereign wealth, the slow-moving giants whose capital dwarfs even the banks, because what we've seen so far, that was just the banks covering. The real buying is still ahead. By the end of January 5th, silver had climbed above $77. Headlines blamed retail excitement, war headlines, or algorithmic trading. But those who understood market flows saw something different, something bigger. The true wave hadn't even hit yet, because the largest players in the financial system weren't day traders or hedge funds. They were pension funds, endowments, sovereign wealth funds, institutions that move billions, not millions. And their annual repositioning, known inside the investment world as the January allocation cycle, had just begun. This was not noise. This was policy, and silver was now directly in their path. Every January, a structural shift takes place within capital markets. Institutional asset managers reassess their portfolios for the year ahead. Allocations are revised, mandates are updated, new models, reflecting new macro assumptions, are deployed, and in 2026, the message from those models is clear. Real assets must rise. For over 4 decades, institutions have relied on the 60-40 portfolio, 60% equities, 40% bonds. It was simple. It was efficient. It worked in a world of falling interest rates and low inflation. But that world is gone. In 2025, both sides of the 60-40 model failed. Bonds posted real losses. Stocks remained volatile. Inflation eroded purchasing power across the board. And for large funds with obligations stretching 20 or 30 years into the future, that failure was unacceptable. Change was inevitable. Silver just became part of the solution. The transition began quietly in Q4 of 2025, when investment committees at major institutions started shifting toward a total portfolio approach. Rather than rigid asset class buckets, capital was to be deployed according to themes: energy security, de-dollarization, climate resilience. All of these themes, directly or indirectly, pointed towards silver. Why? Because silver is not just a precious metal. It is an industrial input for every climate-related investment theme. Solar panels, electric vehicle components, grid storage batteries, water purification systems, 5G, and AI infrastructure. Silver is embedded in the technologies of tomorrow, and the investment vehicles backing those technologies, green infrastructure funds, ESG-aligned ETFs, climate bond portfolios, all require access to it. When institutions allocate capital to climate solutions, they are indirectly allocating capital to silver. And in January 2026, that indirect demand is becoming direct. Consider the mechanics. Institutions don't buy silver coins. They don't trade futures. They purchase exchange-traded funds, ETFs like SLV, SIVR, and PSLV. These funds are legally required to back their shares with physical silver. When new money flows in, new shares are created. When new shares are created, new metal must be sourced and deposited into vaults. It's not a choice, it's a rule. So when a pension fund allocates $500 million into SLV, the custodian must go into the market, find that much silver, and move it into approved vaults, usually in London. But there's a problem. The vaults are nearly empty. As covered in Part 2, the Shanghai arbitrage has already drained a significant portion of Western inventory. COMEX and LBMA vaults are being stripped by industrial and sovereign buyers in the East. There is no surplus metal just sitting around, which means that when ETF demand spikes, the only way to secure metal is to bid the price higher. This is how passive capital triggers active pricing. And the capital is not only large, it is sticky. Retail traders can buy and sell in minutes. Hedge funds rotate positions weekly. But institutions operate on multi-year horizons. When a sovereign wealth fund adds silver exposure, it holds. When a university endowment buys an ETF, it locks that position in for 5, sometimes 10 years. That means every ounce of silver that moves into institutional hands is removed from the float, permanently. It's not available at $80. It won't return at $100. It simply disappears. The result is a one-sided market. Buying continues, selling stops. The price must rise to restore balance. There's also a psychological dimension. Fund managers are under performance pressure. Many are trailing their benchmarks. In this environment, relative underperformance is punished. So when one fund sees another posting outsized returns due to a silver allocation, they are incentivized to chase, not out of belief, but out of necessity. This creates momentum allocation when institutional capital moves not because of fundamentals, but because of peer pressure. A fund manager in New York sees silver up 8% year to date by January 6th. His peers in California and Singapore have already reallocated. His dashboard is flashing red. He buys. Now multiply that logic across hundreds of desks globally. The buying becomes reflexive, volume spikes, and soon silver's rally is no longer being led by news, but by allocation math. What makes this more dangerous is that the supply side cannot respond. Silver is a byproduct of other mining operations. It cannot be quickly scaled. New supply takes years, and existing producers are not accelerating. They are conserving, hedging against political risk, or waiting for better prices, which means the institutions are flooding into a market that cannot grow to accommodate them. The only lever left is price. In conclusion, the fourth force driving silver past $77 and likely beyond is not speculative at all. It is methodical, quiet, mechanical, and it is only just beginning. We saw control break. We watched arbitrage fracture the price. We exposed how banks were forced to buy. We have seen the institutions enter. All that remains is the final step, strategic survival. We will issue the full survival guide for navigating a limit-up silver market, how to protect capital, manage exit points, and avoid being shaken out by volatility, because the storm is not coming. It's already here.